Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast. Today is Wednesday, June 17th. I'm Eric McArdle, and joining me today is John Lewis, our portfolio manager out in sunny Pasadena, California. John, how are you?
I'm doing great, although it's really cloudy here today. So we don't pay the taxes that we do for clouds, so we're a little unhappy at the moment.
Oh, I can understand that. And getting that California sunshine is important, right? And out here in Virginia, we are rainy as well, so we can relate to you. But John, last we spoke, the world looked a whole lot different. We haven't had you on the pod in a while, and we figured it'd be a great opportunity to catch up with you, learn about some of the different perspectives that you've really been focusing on, and make sure that we're looking at all different angles of relative strength and momentum. So I want to start off by bringing in your thoughts on domestic equities and what relative strength has looked like in that universe in recent months.
Yeah, I mean, it's really been a wild ride this year in terms of the kind of the leader-laggard relationship. It's not often we see this sort of volatility in that relationship. And just, before we get to the spread that's on the screen, just anecdotally, we have had some massive days where the laggards will outperform the leaders by 3, 4, 5%. And then the next day, it'll just flip back the other way. And you can see that in the growth value relationship. You can see that in the large cap versus small cap relationship. It's just been an incredibly volatile period with these different buckets kind of performing on different days. And that makes it really, really difficult in the short term to do trading, to kind of position your portfolios, because there's just a lot of short-term risk in making a decision in that sort of environment. I'm sure you guys are seeing that on your side, Eric, when you're writing stuff up for the report, and you might put something in, and then kind of the next day you're looking and it's down a significant amount or up or whatever, and it's just been kind of day to day a really difficult type of environment to implement these strategies.
Absolutely. In just the past month, we've seen significant mean reversion events kind of in both directions, right? Between mid and small caps catching up with the large caps before ultimately, selling off last week. And then now, kind of moving back in line with how that longer term relationship has looked. But outside the size categories, same thing on the style front, right? We've seen value focused equity positions, formerly really known as the laggards, right? And we could say that they have reclaimed that laggard title on a long-term basis. But over the last, 30 to 45 days, a lot of these laggard groups and sectors have been pure RS leaders on a near-term basis. So I can attest to that point, John. We have had a lot of rotation in this near term, and it's been difficult, right? It's been a hard thing to be tactical in this environment. And I think that it's important to, keep in mind as an investor here, number one, what your time horizon is, right? If you're trading or playing these positions on a week-to-week or month-to-month basis, and then acting accordingly, but also keeping in mind that we've had long-term leadership, such as large cap growth, really maintain dominance leading up to the market environment that we've experienced, and then coming out the other end still as a long-term leader.
Yeah, that's exactly right. And I think, what we're both referring to in this kind of near-term laggard leadership shows up really, really well on this domestic spread chart. So what this chart does, for those of you who don't know, is it measures the performance of a basket of leading stocks versus a basket of low momentum or laggard stocks. And we just take the top quintile and the bottom quintile and compare their performance each day and kind of link that together over time. And when the spread rises, that's a good environment for momentum. The leaders are outperforming the laggards. And we're not saying that one is going up and the other is going down. We're just saying on a relative basis, the leaders are doing better than the laggards. So they could both be going down, they could both be going up. But what you want to see is that spread rising. And over long periods of time, it does rise. The leaders are the place to be over long time horizons. But as you mentioned, Eric, more recently we've seen the laggards, and that you can see that really, really sharp drop in the spread, and that's that laggard outperformance. So the things that did really, really poorly in the decline earlier this year. So, think about things like airlines and energy and cruise lines and all that kind of stuff. That has really, really bounced back. And that's that kind of laggard outperformance that we're seeing. That's a really, really tricky game to play. You have to be very, very tactical. And that stuff historically has had big moves, but it doesn't last forever. And so that's kind of where we are now. We've seen this big, big laggard rally, and we're starting to maybe get to the point where that looks like it could peter out, and we can see that maybe in a diffusion index when we talk about that a little later.
Now, John, I want to come back to one of the specific areas in the market that you mentioned, energy, here in a moment. But before we go to that, I do have a question for you and want to get your insights on this. With the acknowledgement that it is a difficult market, that we've had leadership rotating in and out at a fast clip, what kind of advice do you have for those who are listening to this and managing money, as far as maybe looking at their portfolios on a certain cadence or frequency? Anything that you can impart to those at home?
Yeah, that's a great question. So, for those out there who are listening that know anything about what we do here, we tend to be very, very systematic and model driven with all of our strategies. And so they do kind of have examination periods or rebalance frequencies, and we tend to set those up, the rules set up in order to kind of manage those more effectively. So, we have stuff that will look at things on a weekly basis. Some stuff is quarterly. So I think how frequently you examine it isn't as important as kind of how you set your rule set up to manage that frequency. And by that, I mean, what you don't want to do is you don't want to get into the situation where, for example, you're going to look at something weekly and you've got a ranking system or an indicator that's going to generate way too many signals. It really is important with this momentum investing methodology that you trade the trend and you don't trade the noise. So if you're flipping your positions out constantly, there's a lot of short-term noise that exists in the market. And when you trade on that, it really is problematic. And we've written some white papers on that over the years. If you're looking, for an amount of data that you want to use, like somewhere between like a 6 and 12 month window of prices is really kind of the measurement where all the alpha is. So it's not like you should be reacting to all these little moves all the time. And that's why when you have a laggard rally like this that takes place over, 30, 60 days, something like that, it's really, really difficult for a momentum strategy to handle, because if you have your system kind of calibrated to pick that up super quick, then at other times you wind up getting whipsawed a lot. And a lot of times we'll refer to that as being killed by the paper cuts. So it is a difficult thing to go through when it's happening, but you really do need that kind of long-term vision. And whether you're going to look at your portfolios weekly, monthly, quarterly, they can all work, right? What you just want to do is make sure that when you're examining them, you're not doing things too quickly and trying to get ahead of the trend. You really need to follow that trend.
Well said. Now, I want to shift gears a little bit and talk about what to me has been the laggard in the domestic equity market over the past few years. Namely energy, right? Which as a sector, large cap value constituent, has really, really struggled and has had some trouble with the underlying fluctuations in the commodity of crude oil that can drive energy stock performance. It's just been a tough place to be for investors over the past few years. However, off this market bottom, we've seen energy really ascend to new heights, at least on a recent historical basis. And in fact, what we're showing here is our dynamic asset level investing tool on the NASDAQ Dorsey Wright platform, where energy has ascended to the top ranked sector group in Dolly. And one of the things that, John, I want to get your opinion on today, because I think it's important. We've talked about the systematic approach behind using momentum, behind using relative strength and trend in your practice. We want to maybe take a look under the hood at what drove energy to the number one sector ranking, and then pair that with another type of trend and relative strength measurement that we use on the NASDAQ Dorsey Wright platform called the fund score. And so, John, I'll turn it over to you. When you're looking at a sector like energy, can you give us some idea for, what has really driven energy to the top of the sector rankings from a purely RS perspective?
Yeah, so from a purely RS perspective, I think it really depends on what tool you're using to measure momentum. And we'll get into that, I think, a little bit more, but the Dolly tool, right, really uses point and figure relative strength exclusively to do all this scoring. And if you think about how point and figure is constructed, right, it takes time out of the equation, and it really focuses on volatility and price movement, right? So what you see with energy is you see something that has been beaten up for a number of years, as you've mentioned. In fact, I mean, it has gone from, I think it was 2013, maybe 2011. It was, double digits in terms of weight in the S&P 500, and it has just underperformed since then and has cranked all the way down to below, 3% or so of the S&P 500. So it has been a dramatic underperformer for a number of years. But getting back to kind of what's gone on more recently, when you have a lot of price volatility with a point and figure chart, it gets very, very easy to generate buy and sell signals. So as these things get very volatile, and like we saw near the bottom in the reversal up, there are a lot of back and forth columns that get put in, and it makes it very easy to give a new buy signal, a new column switch, that sort of thing. So that's why you see, like in a point and figure type of method, you can see energy doing very, very well. But if you rank it on, say, a trailing 12-month performance, it might not be anywhere near as good as if you're doing it on a kind of a point and figure methodology. So there are definitely like conflicting signals going on. And it really just kind of has to do with how you're choosing to measure, quote, momentum at any one given time.
Great. And for those of you who are tuning in, we do have a YouTube version of this podcast in which we're showing a chart, relative strength between the Energy Select Spider ETF and the S&P 500 index on a 3.25 RS scale. And that does provide a pretty solid picture of what John was explaining about the long-term underperformance, the volatility off the bottom, and then the subsequent buy signal that energy has moved to. And, John, as you alluded to and as you mentioned with regard to the strength of the signals and just the differing of, the different types of methodology here, the energy trade has actually been pretty good so far, right? Acting on this signal. It's been an opportunistic play that has worked out well so far. So that signal, while maybe surprising to people when looking at the longer term picture for the sector or even the longer term relative strength chart, has thus far been fruitful, right? And so, as you mentioned, the consistency of momentum across the different methodologies in terms of providing those longer term, what you hope to be outperformance, so far standing up here. But the contrasting example that we have and we get a lot of questions on internally are the fund score method, which is a different way of looking at relative strength and ultimately trend on the NASDAQ Dorsey Wright platform. And for those of you at home, that fund score is ranging from 0 to 6, with a 6 being the best. 3 or better is acceptable, and 4 or better is considered optimal. And we assign this score to every ETF and mutual fund on the NASDAQ Dorsey Wright platform. And they update daily, even if by a very slight margin, right? It's a very dynamic reading, whereas a relative strength signal, as we looked at before, a buy or a sell, is a little more static, right? We're really just focused on that confirmation of strength or weakness to determine where we ultimately want to allocate capital. But in the fund score, John, we look at XLE, we see a score of 2.10. And now, as I mentioned before, that's below the 3.0 optimal fund score. But we've seen a really sharp and robust move off the bottom. Notice that positive score direction of 1.97. So nearly all of the score component has been attributed in the last 6 months of price movement. And when we look at the chart for XLE and we zoom in a little bit more on the recent chart action, we see multiple consecutive buy signals off the bottom, some consolidation in the interim as far as May and June goes. But overall, we have a nice secondary trend that has formed on this chart. And so, again, conferring back to the pure RS view of Dolly, this opportunistic play has been a good one, right? And so we think it's important just to be transparent with you all at home regarding the different types of momentum, the different types of readings that we can come to on the site and on the platform, and just saying that most of the time they're going to match up and most of the time they're going to get you where you need to be. But in some cases, you will have a little bit of a different reading. So just worth keeping in mind, right? We're looking at the trend component with that fund score, as well as relative strength and pure relative strength. So good stuff, John. I'm glad.
Let me just add a little bit to that, because I think it's important that people know, kind of from a macro view, what we're talking about when we talk about like different ways to measure relative strength and momentum. And that, I think people get confused by that a lot of times. And I think if we can put it into context, it's no different than when you're looking at value and value measures for certain stocks. There's different ways to do it. And those don't always line up either. You can have a stock that is that scores very well on a price to sales basis, but does not score well on a price to book basis. You could have, something scores well on price earnings, but does not score well on price to cash flow. So there are different ways that people measure value. There are not any right or wrong ways to do it. It's just different ways to look at things. The same is true for momentum, right? There are different ways to measure it, whether it's a pure point and figure method, whether it's like a fund score type of method, whether you're just using a price window, whether you're putting moving averages on it. All of these things work over time. Again, we have white papers on that too, where we test a number of different types of methods and price windows and things like that. Some historically work better than others. We have no idea whether that will hold true in the future. We believe it will, but maybe 12 months tests best, and maybe 9 months works better going forward. But what we do know is that this idea of buying and holding strong stocks is ultimately what drives the portfolio. And it's less about the individual names and more about the method, about cutting the losers out and reallocating those funds to the winners in a very systematic and disciplined basis, right? And when you think about what we're trying to do with momentum, ultimately we're trying to capture big multi-year moves, whether it be in sectors, whether it be in individual stocks. I know if you read the daily equity report, I think it was yesterday where you guys put in Danaher, which has been on a buy signal forever. Those are the types of things that you want to find. And the reality is you make most of your money in these strategies off a small number of the trades, kind of the 80-20 rule. 20% of your trades are really going to drive like 80% of your profits, right? So what we're doing is we're trying to get these multi-year trends and it doesn't happen all the time. And so when you get these conflicting signals, right, where one measure is telling you one thing and another is telling you another thing, it's not really a problem, right? Because what's going to happen is if energy, for example, turns out to be a big multi-year uptrend that you have to be in, eventually everything gets you there, right? A strong stock, strong sector, right? Eventually it's all going to get you there. And something might get you in sooner, something might get you in later, but you're really looking to make your money in the meat of the move, right? Not at the very beginning or the very end. And you might get conflicting signals, but let's face it, a strong stock is a strong stock no matter how you measure it, right? And those are those kind of like 20 percenters where you make all your gains. Everything is going to align. So the advice I would have when you get these conflicting signals is, go with kind of how you've set your process up and just follow it. And if something is lagging, right, it'll eventually get you there if it really is that strong. And if you're getting in early, you might have stuff down the road that you get in early and then it turns around, and that's a whipsaw. That's kind of the downside of doing it that way. So there's no right way or wrong way. The right way is really to follow your process, to be very disciplined about it, and to realize where you're looking to make all your money, which is in the middle of that move. And like I said, once you kind of get there and things are strong, all these measures are going to line up. And that's really where you're looking to make the majority of your money anyway.
Yeah, what a great reminder. I think just reaffirming that trusting the process and that we're looking for those long-term trends is really, the name of the game here for most of our clients and most of our investors. John, good stuff. I'd like to pivot a little bit and look outside the U.S., which of course has been a primary focus for most people in terms of being an RS leader on a macro perspective, but shifting abroad, right? We've had not only an interesting 2020 in the U.S., but of course around the globe. We've had a ton of turmoil and reverberation from this financial and healthcare crisis impacting international markets. What does the picture look like abroad from a momentum perspective? And are there any takeaways that we can glean away from some of the pure RS data that we've seen?
Yeah, so if we look at just kind of like asset class rankings, in Dolly, for example, international just, isn't anywhere near where we are on a domestic level. But that's not saying that we haven't been able to find opportunities there. I think it's just been a little more difficult, and I think you've just had to be, frankly, like a little bit more creative about finding your opportunities. Those aren't areas where you're just kind of throwing a dart at a large cap-weighted benchmark and it's working out. But if you're willing to kind of overweight certain countries or overweight certain stocks, maybe go, differ from the benchmark, the performance has been there, and we've seen that in our international strategy. It's having a very, very good year after having a good year last year, and that really relies a little bit more on individual stock picking rather than just kind of having a large broad market benchmark. And we can see that if we look at the spreads, we also have those on an international basis. And if you look at the developed spread and the emerging spread, they look somewhat similar to the U.S. In that they had nice runs, and the leaders really did hold up well during the decline. And over the last month, 2 months, we've seen a big laggard rally there. Now, the biggest difference between the two spreads is the emerging spread has been much, much stronger than the developed spread, which is interesting, just meaning that the dispersion between the leaders and the laggards on the emerging market side has been much more pronounced. And we've seen kind of a much better trend leading up into this laggard rally on the emerging side. So while things aren't ranked as highly from an asset class perspective in international, we're finding that there are good opportunities there. If you're willing to have a lot of active share in the portfolio, which just means if you're willing to differentiate from the benchmark and look around for some opportunities, they're definitely there. And you can generate some good performance, even though the asset class as a whole isn't ranked as highly as some of the other asset classes out there.
That's really interesting, looking at the emerging spread being as high as it is overall. And I think one of the surprises that we've communicated in our research on the international equity side within emerging markets is the strength of Chinese equities. And coming with the coronavirus COVID-19 outbreak originating in China, and then of course, them being kind of the pioneer on the shutdown from an economic standpoint. It just is one of those points where I think if you are using technical analysis in your practice, being able to identify price movement and separate away from whatever is in the headlines or whatever prevailing narrative is being passed around is so powerful in being able to identify opportunities for outperformance. So just kind of tying those 2 points together on the Chinese equities and emerging market side. But yeah, good stuff, John. I'm with you. I think as long as you use RS in a systemic way across different asset classes, you should get the same results, right? It's just putting different names on the investments, all things considered, and being able to utilize a momentum-based approach to find winners and avoid losers. So with that, we'll shift gears one more time to our final broad asset class for today's update. And we're going to look at fixed income, which has had a ton of leadership rotation over the past few months, and of course has been more volatile than what one might expect in being a bond investor, right? We've seen significant changes. We've seen a continued downtrend on a long-term basis of long-term interest rates. And of course, Fed policy is certainly a topic of discussion for not only bond investors, but investors in all asset classes. And so, John, with that backdrop, what have we seen from a tactical fixed income approach, and what has worked? What have we seen from a changing perspective as the market has experienced this volatility?
Yeah, I mean, volatility, I think, is the key word here. It's really been a roller coaster. I don't think that fixed income investors are used to this kind of volatility. And we've seen things really, really shift around quite a bit this year from a risk on, risk off type of perspective. So, before the decline, we had risk on in our tactical fixed income strategy. We were aggressively positioned, things like corporates and high yield and emerging market bonds and even convertible bonds. That all kind of unwound during the decline, and our strategy really, really went risk averse. A lot of short-term treasuries came in, even long-term U.S. treasuries, and that was great. As you mentioned, the Fed lowering rates to try to stimulate the economy, that really, really helped during that period. And then we've seen it kind of come full circle and go the other way back to risk on. And we've seen all that risk come back into the portfolio. The Fed, again, has really helped. They've committed to buying a ton of not only ETFs, high yield bond ETFs, investment grade corporate ETFs, for example, but, now they're starting to buy individual bonds. So they are really, really helping from a risk perspective, kind of clean up anything that might be a problem and just support that whole area. So we've seen that kind of come back, and it's really paid to move around and to be tactical this year. And there's been some really, really big swings that you could have capitalized on.
Yeah, that's right. And just the movement, out of risk and then back into it is really, I think that would be a difficult thing to manage in any environment, but to do so without relative strength and to do so without the tools that we provide on the platform. I know I would certainly be flying blind here. So when we look at the Dolly rankings that are up on the screen once more, within fixed income, as you mentioned, John, we see those riskier credit-based assets that have moved back to the top of the Dolly rankings, including preferreds and convertibles. high yield debt, and then U.S. corporate and the third ranked overall sub-asset class spot. But as you mentioned, John, with the volatility that we've seen in fixed income and, notably in a tactical fixed income strategy that has had to reshift and figure out, where it needs to be from a risk and reward standpoint as the market has changed. One observation that we've been pointing out is just the strength of core bonds in general and how they've held up extremely well. And so, from a management perspective and from an asset allocation perspective, we think it's worth the reminder that pairing a tactical strategy with a core bond strategy is really a great way to maintain exposure to the asset class, right? Because in times where you need to be a little bit more risk on, and when you can afford to be a little bit more risk on, you want the ability to do that. However, the core bond exposure gives you something more akin to what you might expect of traditional bond exposure, in that you might get a little bit less volatility when the market draws down. You might have a little bit more of an expected outcome. So, notably when we look at one of the main core bond index products, the iShares U.S. Core Bond ETF, ticker AGG, we pointed out here recently in our research that the fund has moved back to a buy signal with a triple top break at 117.80, which has catapulted it back into a positive trend. And, just revisiting that fund score concept from before, AGG's is a 5.23, which is stellar by all measures. And so really a testament to not only the trending strength of the fund and of core bonds in general, but also of the relative strength picture against other asset classes like equities. So, bond exposure, definitely something that is worth paying close attention to here. We looked at Dolly earlier and noticed that fixed income is near the top of those rankings, still outranking domestic equities. So while we see opportunities in U.S. stocks and we think that there's certainly a position there, it is not a good time to neglect that bond piece of the portfolio. So, well, with that, John, I think we've gone around the world and back. It is always great hearing from you and catching up with you and getting your insights and perspective. We have a couple of places where we can follow you and the work that your team is doing out west. On our platform, we can go up to the models and products section and then look at products. The products are going to show the SMA strategies and ETFs that the NASDAQ Dorsey Wright team here in Richmond and out in Pasadena put together. So if you are at home and you're looking for some different ways to implement momentum or implement relative strength across different asset classes, it's a great place to look. Additionally, John, one of my favorite parts of the site, because by now we're all kind of geeks for this stuff, under the resources section and media and education, you've got a number of white papers that you've published, and you alluded to some of those earlier in the call. For those of you at home listening or watching, I highly recommend checking these out, looking at the RS box sizes, RS signals. Those are some of my favorite that I know John has had a big impact on our research and what we've communicated by publishing. So be sure to check those out. They're great evidence that backs up what we're doing as far as a management perspective, but also they're great collateral to share with your clients and really give them some confidence in momentum-based strategies. With that, thank you all for joining us this week. If you have any questions, don't hesitate to reach out to us at 804-320-8511 or drop us a line at dwa@dorseyright.com. We always love hearing from you, and we like your feedback as far as what you like about today's presentation and what you think we could improve upon. And with that, we'll talk to you next week.